Hey everyone, welcome back to Corporate Decoder. Today, Harte Hanks HS just filed their quarterly report, a 10Q for the period ending the 30th of June 2026, and there is a massive acquisition happening that changes everything. Quick note, this is not financial advice, just my take on public filings for educational purposes. Harte Hanks is being bought by Star Equity Holdings in a deal that could be worth around $5 per share. This filing gives us the financial picture right before that massive change. Let's dive into the numbers for Harte Hanks, also known as HHS as of the 30th of June 2026. The company reported total assets of about $88 million. That is down from over $91 million at the end of 2025. On the other side of the balance sheet, total liabilities stood at around $72.7 million, and total stockholders' equity was about $15.3 million. This is a pretty significant drop in equity from over $20 million at the end of 2025. Looking at their performance, the company had a net loss of $5 million for the 3 months ending the 30th of June 2026. This is a big jump from a much smaller loss of just over $300,000 in the same period of the previous year. For the first 6 months of 2026, the net loss was even larger at $5.6 million compared to a loss of about $700,000 in the first half of 2025. That is a substantial worsening of their financial results. This translates to a loss per S-share of 67 cents for the quarter, compared to just 5 cents in the prior year. For the half year, the loss per S-share is 76 cents, up from 10 cents a year ago. Clearly, profitability is not improving. Let's talk about revenue for the quarter ending the 30th of June 2026. Revenue was down slightly to about $38 million compared to roughly $38.6 million in the same quarter of 2025. This small dip might not seem like much, but it is part of a larger trend. For the first 6 months of 2026, revenue was $75.2 million, which is a 6.2% drop from $80.2 million in the first half of 2025. This shows a consistent decline in their top line. Now, here is where things get interesting. Even though revenue slightly decreased, their operating expenses actually went up by 10% for the quarter, reaching $42.5 million compared to $38.6 million in the prior year. This is a big red flag. When your expenses rise faster than your revenue, your losses are going to widen. A big part of that increase came from advertising, selling, general, and administrative expenses, which shot up by 58.6%. The report mentions this is primarily due to higher professional service and legal expenses. This makes sense given the pending acquisition. They also incurred restructuring charges of $187,000 in the quarter, up from $149,000 in the prior year, mainly due to higher severance expenses. This indicates they are still trying to streamline operations, but it is costing them money. Looking at their business segments, Revenue Solutions saw a 13.2% revenue drop in the quarter. This segment is described as their most economically sensitive, meaning it is hit hardest when clients cut back on marketing. Customer Care, however, showed some resilience, with revenue increasing by 8.5%, driven by new customers. But their operating income in this segment fell by nearly 59%. The reason given is higher labor expenses due to increased headcount for new business. So even where they are growing, it is becoming more expensive to do so. Fulfillment and Logistics Services revenue also declined by 2.8%. Overall, the company seems to be struggling to maintain its revenue base, with new business not fully offsetting losses from existing customers or reduced spending. Let's check out their cash flow. For the first 6 months of 2026, the company used $2.6 million in operating activities. This is an improvement compared to the $5.7 million used in the same period of 2025, but it still means they are burning cash just to keep the lights on. Their cash position is also quite low. At the end of June 2026, they had about $5.2 million in cash and cash equivalents. This is down from $5.6 million at the end of 2025. Interestingly, they had $2.9 million in cash provided by financing activities in the first half of 2026, largely because they borrowed $3 million under their credit facility. This is a clear sign they are relying on debt to manage their cash flow. Speaking of debt, Harte Hanks has a $25 million revolving credit facility with Texas Capital Bank. This facility was recently amended to extend its maturity to June 2028. As of the 30th of June 2026, they had borrowed $3 million under this facility. While it provides some financial flexibility, it also means they have more debt to manage. Now, the biggest news is the merger with Star Equity Holdings, announced on the 14th of August 2026. This is a major development. Star Equity plans to buy all outstanding shares of Harte Hanks in a stock and cash deal. Each Harte Hanks share will be exchanged for either $5 in cash or shares of Star Equity's preferred stock. However, there is a cap of 50% on the total cash that will be paid out, meaning many shareholders might receive preferred stock instead of cash. This deal comes with its own set of risks. The merger is subject to approvals from both companies' stockholders and other conditions. If the deal falls through, Harte Hanks could be on the hook for significant transaction costs, and their business might suffer from the uncertainty and distraction. Plus, there is the risk that the integration of the two companies may not go as smoothly as planned, potentially impacting the value of the Star Equity preferred stock that some Harte Hanks shareholders will receive. So, what is my take on all of this? Harte Hanks has been struggling financially for a while. Their revenue is declining, their expenses are rising, and they are losing money. The increase in operating expenses, particularly in areas like legal and professional services, coupled with the widening net loss, paints a picture of a company in a tough spot. The acquisition by Star Equity Holdings at a premium price, per share around $5, does offer a potential exit for shareholders. However, the structure of the deal with the cash cap means not everyone will get cash, and the value of the preferred stock received will depend on Star Equity's future performance. The risk I am watching is whether the combined entity can truly turn things around. Harte Hanks' core business segments seem to be facing headwinds, and the success of the merger will hinge on Star Equity's ability to integrate and create synergies. If the integration is not successful, the value of the preferred stock could significantly decline, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.